Welcome back and Happy New Year. Crypto, Bitcoin specifically, up over 45,000 as we enter the final potential weeks here in the beginning of January, awaiting that ETF approval. Bitcoin up now 6.6% in just the last 24 hours, making up basically all of its gains for the last week. Ethereum up about 6.7% on the week. Solana up another 8.4% in the last 24 hours, though barely positive for the week. But also interesting, now we've got, and this is one that was definitely not, as they say, on the bingo card, this idea of now an Iranian warship going into our good old Red Sea, as well as Maersk once again pausing shipments. Not ideal. Kind of went into the Christmas season projecting that, hey, as soon as U.S. warships arrive, we'll be good. We'll have stability in the region. Now it's not just U.S. warships, but it's Iranian warships in the Red Sea. At the same time as Maersk's like, you know what? The protection the U.S. is giving us isn't enough. That was a little bit surprising to me. It's almost sort of like we got a little bit of a half-aid protection over there. Not ideal. So that's led oil prices to move up again. Some are saying that's also one of the contributing factors to why futures are as red as they are right now. Although then again, Barclays did downgrade Apple going into the new year, leading Apple to sell off about 2%, which tends to be a little bit of a drag on the index. But also bonds. Going into the new year here, we've got the 10-year selling off a bit with yields up 11.3 basis points on the 10-year. You've got oil prices on the international blend up to 78.61. Now, that's not as high as what we've seen here recently. We went as high as about $81 following some of the good old Red Sea drama, but it's ticking back up in that direction. So we'll see how markets end up behaving. We're waiting for Tesla delivery numbers as well at the moment, so we'll see what happens here. But we are also looking at what's the first week going to bring us. The first week could be really interesting for predicting returns. In fact, if you look at the past, if you look at 2019, 20, 21, 22, and 23, the first 5 days had basically 100% success in predicting how the entire year would go when it came to the stock market. So take a look at this chart on screen right here. Look at that. In 2022, when the first 5 days were negative 1.9% on the S&P 500, the entire market moved down negative 19.4% for the year. And in 2019, 20, 21, 23, in those 4 years, when the first 5 days were positive, the stock market ended up being positive for the entire year. Now, they're only showing 5 years here. Usually when we see analysts putting together such a small segment of data, it's because it starts failing outside of that little window here. So I'm not horribly convinced that that's going to be a perfect indicator, but it is interesting for the last few years to see. So again, we're looking for Tesla delivery numbers. We've got those on standby. Then, in addition to that, we want to see how markets end up moving in regard to oil this morning. How much more or less is oil going to move? And how are those 10-year treasuries going to move once the market's open? Looking at some of the pre-market movers, let's see where some of the pain is this morning. We've got, drop in right here, SunPower down 2.69, Intel down about 2.6. You've got Redfin down about 2.6, ARM Holdings 3.5. Look at Apple there, 2.3. It's a big drop there on Apple. Apple is another one of those that folks were looking for a breakout at 200 at. Once you get to about that 200 level, that's not only where you cross all-time high, but you also cross that psychological threshold of 200. It's sort of like an NVIDIA 500. It's been somewhat challenging for some of these companies to really pull through. You've got Palantir dropping. Look at this, below $17 now on Palantir here. Some seeing this as an opportunity going into Palantir earnings. They can really prove some of the software AI revs they're pulling off. I personally also agree. I think that's as a software AI play, it's probably the only software AI play I'm really interested in. Let's look at on the green side what we have here. We have oh, look at that, Zim back up. I mean, this is almost like your trader's play right here. You just have to be careful because it moves so much. You can't really hold any kind of trade here long term. It's like you got to play the trade during the day. But this is the first trading day going into the new year, where we also have now these escalating Red Sea tensions. Iran keeps suggesting that they want peace in the region, that they don't want any kind of drama or negativity with the United States. But then why Iranian warship dispatched to the Red Sea after the U.S. Navy destroyed 3 Houthi boats? Like, why are you coming to their rescue? It's because you back them and you actually do want tension with the U.S. So it's almost like your actions aren't aligning with your words, although that's not a horrible surprise for Iran. Keep in mind, Red Sea handles about 12% of world trade. As a result, what does that tend to signal to folks who are more bearish? Oh, the return of inflation. Okay. It's always the return of inflation. Look, what I do think is interesting is let's jump on over to good old Nick T. Let's see what Nick T has to say about multivariate core. He's got his first tweet of the year. Honestly, he's tweeted like nothing for the last 2 weeks of the year. I think he took a vacation or whatever, which good for him. That's okay. Who says you can't take a vacation? But the first thing he does when he comes back is he tweets my favorite, multivariate core trend inflation. He tweets here that the New York Fed's measure of underlying inflation, the multivariate core trend, ticked down to 2.3 in November from a downwardly revised 2.4, originally reported as 2.6, for October. So let's actually go jump into that chart ourselves. Multivariate core inflation. I can't always do this. I just like going to the source of the data. I'll take the perspective and then I want to go to the source of the data. So let's go to the source. That's right here. Now let's play with the chart a little bit. So I like going to decomps, and I'm going to pull this into our COVID era here. I don't really need before that. I know before that was a disaster and low. And I'm going to remove goods here. I'm going to remove housing. And all I'm going to look at for a moment, look at that, services x housing. Let me actually zoom out a little bit more just to see the up on that. There you go. So this is, you know what, let's get some history here. Services x housing, how interesting. So we had been sitting right about at that at the little line there, the little zero line. We'd been bobbing up and down below that in the last decade before the pandemic. We were sitting well above that, though, for a while before that, you know, in the mid-2000s and such. But we were also fighting inflation around 2006, running a little too hot, around 3 to 4%. So, looking at this trend, though, it's pretty obvious that services x housing, which folks have been very worried about, especially because you have, a strong labor market that can fuel services inflation. You have multivariate core services x housing dropping pretty consistently here. I know there was a freak out there for a moment. I remember covering it when we had these September numbers and this little uptick. People were worried, oh my gosh, that's it. This is the start. It's like, well, I mean, it is a volatile index. You know, we've seen upticks here, a little bit over here. You know, it's not horribly uncommon to see volatility in some of these numbers. But boy, look at that. I mean, just on a charted set of data, it's no inflation. Instead, then when we align that with what we see in earnings, there's no inflation there either. What I do think is interesting is what I covered this weekend on eHack. I touched on both Disney and Netflix, bragging about how much they love the ad-supported tier for their subscribers and how well it's doing, and how they think their products, and this was a Disney quote, they think their products are, quote, an advertiser's dream, just because they can get so much data on connected TV. I think as we continue to see this sort of disinflationary, potentially even deflationary trend in goods, you end up getting companies advertising more going into 2024. Not only that, but you have a political season as well. We'll see. But let's look at goods. I want to see goods for a moment. I mean, this one's should be obvious. Yeah, look at that. So there's deflation in our goods section here. So goods on multivariate core sitting in deflation. How often do we sit in deflation? Let's just go zoom out for a moment. Yeah, pretty common. The decade before the pandemic, we were sitting in goods roughly deflation, pretty much deflation. .com era. Yeah, we've actually probably since about 1997 spend more time below zero than above zero for goods, which makes sense. I look around, things either have gone up in quality or gotten cheaper. I know there are people who like to say, I don't know, man, the quality of this XYZ always used to be better. I don't know. We should. I guess maybe we can name a few things. Yeah, like a good one that I like to compare to is people like to say, and this definitely comes across as true. Older ovens, just as an example. Back, like, you could get an oven from the 80s, and the thing would work for like 40 years. You get an oven today, and the thing works for like 5 years. And one of the big differences, and I'm not saying that's good, but one of the big differences is ovens have gotten ridiculously cheap, and you put an oven in for like $600. Well, like a range oven. No, you get even more. But they have so many chips in them now, and some of these chips are so darn sensitive, and you get these regular surges in your homes. Unless you have surge protectors everywhere, and quite frankly, even surge protectors everywhere, they don't necessarily help. Even sensitive ones don't necessarily help from like in-home surges. Like when your AC kicks on, technically you get a little power surge through your house every day. But anyway, these little sensitive chips, they just break. And so if we just removed the sensitive chips, man, this stuff would last long, but then you wouldn't have all the little bells and whistles. So it's kind of interesting. But there are definitely little anecdotes where you'd be like, well, they don't make things like they used to. But in general, quality goes up over time and price comes down. And one of my favorite examples, of course, is TVs. You look at, size up, definition up, price way down. Quality of compute way up, and price relative to that compute power way down. Anyway, so this is not horribly abnormal. Now, if we look at a multivariate core trend, and we go zoom into this section over here, again, people have a little bit of panic about, oh no, it's the resurgence over here in inflation. Yep, nope. Right back down. So we'll watch this. Obviously, we've got big catalysts coming up here this week. We've got jolts and jobs to pay attention to. Nothing really today. Big thing today will be Tesla delivery numbers, which should be out before the bell. So that gives us about 50 minutes to go. We've got S&P PMIs. Those will come out. Excuse me. As well as construction spending. So both of those will come out 9:45 and 10 a.m. California time here. So we'll get some nominal numbers here. But more interesting will be tomorrow. We'll get ISM prices paid, new orders, jolts, the minutes from the Fed. We'll get, that's tomorrow, Wednesday. Then on Thursday, we'll get the ADP numbers along with initial claims for unemployment. Friday, we'll get the jobs report. Week after that, we get CPI. It's going to be entertaining. Buckle up. Let's listen in over here. Oh, look, Rivian deliveries are out.
Coming in line and basically a little better than expected production-wise. Let's start first off with Q4 deliveries, just under 14,000. The FactSet consensus was for 14,000 vehicles to be delivered in Q4. Production, 17,541 for the fourth quarter, but for the full year, coming in at 57,232. Remember, the guidance from Rivian was 54,000 vehicles.
Oh, Tesla deliveries out. 484.5 versus 483. Slight beat at Tesla. Production 494.9 versus 482. That's a beat. Beat on production and beat on deliveries.
From Rivian for all of 2023. Back to you.
What do you think might be behind this pre-market drop, given that, you know, the delivery numbers came in 57 instead of the estimated 54? Is there margin concerns or what?
Well, I think there's going to be margin concerns there. There's also going to be a few questions in terms of, well, you built more vehicles than expected. How come the deliveries didn't increase a little bit more? But that's really getting nitpicky in terms of what the investors might be looking at this point, Robert.
Got it. Thanks.
Yeah. Stock also up 35% since late October, so could have something to do with a little bit of the pullback as well. All right, coming up, all about the 2024 retail landscape.
Yeah, all right, so let's take a look here. Rivian now down about 4.3, so sensitive to that miss there. Tesla, I think in the pre-market was, let's see here, let's go to the 1 minute and see what the reaction is. Yeah, it's been a little volatile here in the pre-market. Tesla down about 0.69 basis points, classic. And but then again, the entire broader market has been red. Pretty sure this was down as much as 1% a little bit ago, but that is a beat on deliveries. I'm actually oh, there we go. Now it's starting to move green here. I think as word is spreading, perhaps. But that is, I will say, that is really impressive. I have to say, very, 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 very impressive. The fact that in Tesla's worst quarter ever, you know, you ended up having, well, when I say worst quarter, let me just clarify what I mean by worst quarter. When I say worst quarter ever, what I mean is you have the highest interest rates in the history of Tesla occurred in this last quarter. I honestly think some of that credit expiration was a gift to Tesla. Like the fact that that credit was expiring was almost a way for Tesla to push some sales in 2023. Although you've got quite a few of the Tesla vehicles still receiving the credit. In fact, 50% of vehicles that were getting the $7,500 tax credit or $3,500 tax credit are no longer getting it. So you're at a place where Tesla and Rivian are almost some of the few who are still getting the credit. Take a look at this. Here's the credit list. You've got Model 3 Performance getting $7,500, Model X Long Range getting $7,500, Model Y All-Wheel Drive, Model Y Performance, and Model Y Rear-Wheel Drive, all getting the $7,500. All of the Rivians are only at $3,500 for the Rivians. And then you've got the Ford Lightning has the full $7,500, and then the Bolt, which, who wants that? Like, why would you buy a Bolt for an MSRP of $55K when you can get the Model 3 Performance for the same MSRP? Anyway, yeah, very interesting. So it's also worth noting that Model 3, specifically Q4, Model 3 and Y deliveries came in at a slight miss, 461.5 versus 462.5, but that implies that more S's and X's or Cybertrucks were sold to offset, which is good for margin. Really interesting. So we'll see what ends up happening with Cybertruck deliveries as well. We don't have Cybertruck deliveries showing just yet. But as we can see, Tesla now moving positive here, up about 84 bips. Apple still -2. You know, I mean, it's. I've been positioning for this since November of, maybe even a little bit before, November of 2021. Sorry, 22. November of 22, and that's the belief that Tesla's been left behind. It kind of still has been over the last year. So still pretty exposed to Tesla. So we'll see what happens. Definitely have some bias and exposure to it. But then I always, when people, people always say that, they're like, oh, you're just pro Tesla because you have Tesla stock. Or, you will have to always ask yourself, or ask other people as well, when they have what's it called? When they have a position, what came first, their position or their reaction, like or like their belief in the stock or their position, right? So I always think that's interesting. It's like, well, did you believe that the stock was going to do well first and then get the position, and then you react to news, or is it, I don't know. I don't know. My point is, where I'm trying to go with that is, like, people are always like, oh, if you got to buy, it's just like, well, again, put your money where your mouth is. Anyway, whatever. So let's look at other things here as well. So we've got, interesting. It's interesting. Tesla is positive, but the headline here that's coming through on the little notification. Tesla reported Q4 deliveries that met analyst expectations. It actually slightly beat. And then it says shares fell. I mean, I don't know about who's writing these headlines, but whatever. Because it was beat and shares went positive from negative, but okay. So anyway, bond's still up 10 basis points, sitting at 3.96. It's going to be really interesting how this spring plays out for real estate, mostly because I think you're going to get some sweet, sexy inventory this spring. And I have no idea what that's going to mean for price action on properties, but we'll pay attention to it. Then we've got Brent up 2% still. No big movements here. Let's see if the SPY is moving at all in the pre-market. Beyond, no, not really. It's been about the same, negative about 70 basis points here. And a lot of little red here. Posted a video yesterday where I talked about this idea that a lot of the money we have sitting on the sides on money markets could end up coming out to do some dip buying in the event we get some dips. Who knows? Maybe this week will be the first test of that. Obviously, too early to tell here with about 43 minutes to go before the opening bell. What else do we have here? Let's listen in here. Oh, look, now they want to cover Tesla. Boy, we covered them like 7 minutes before they did.
The street was expecting closer to 473,000, so better than analyst expectations. And because of those deliveries topping 475,000, they topped their full year delivery guidance of 1.8 million vehicles. Officially, it's 1.808 in terms of 1,808,000 vehicles delivered in 2023, an increase of 38%. And again, the street guidance, or I should say Tesla's guidance, was for delivering 1.8 million vehicles. By the way, fourth quarter production, just under 495,000 vehicles. We will get the fourth quarter and full year financial results after the bell on the 24th of this month. So what, 3 weeks away in terms of when we hear from Elon Musk in terms of the setup. And that's also, by the way, guys, when we are likely to get the company's guidance for deliveries for 2024. That's when we will probably get them, again, 3 weeks from now. Guys, back to you.
Perfect.
Yeah, that is also so interesting, is that when we get delivery numbers, it really allows people to do their estimates for how much money Tesla made in the quarter. And the fact that Model Y and 3 deliveries came in shy of expectations, and production and deliveries as a whole beat, somewhat implies that some of the higher margin vehicles might have been selling here. So, which is good. I honestly think it's because the Model X has gotten cheaper. It's a fantastic car. Personally, I wish I bought the X Plaid instead of the S Plaid. I got the S Plaid because I already had the X, but now my dad rides my black X. It is great. But look at this. I mean, you can now, let's take a look at this. Let's go to order Model X here for a moment. Let's get rid of the bookmarks bar. There you go. Let's go to purchase price. Yeah, look at that. $79,900 now for the Model X. I don't know that I personally, like, if I had to go back, I probably wouldn't pay $15,000 for, 1.3 seconds. 3.8, still very good. I wouldn't pay the extra money. I would go for the 79.9 version. And the car's fantastic. But I still think the most bang for your buck is the Model 3. The Model Y. Scratch that. The Model Y, I think, is your most bang for your buck. And so if I compare the Model Y here, oh, wow, look at that. Model Y, that's almost half the cost of the X. $43,900 for the basic rear-wheel drive one. Does that one qualify for the full credit? Let's find out. Model Y rear-wheel drive. You got to be kidding me. And these are MSRP limits, not the actual MSRP. That's interesting. But look at that. Model Y rear-wheel drive, 44 grand. So, and then you get the $7,500 on top of that. So, 44 minus 7,500, that's $36,500 for the Model Y. Heck, if you want to buy one, make sure you use the referral code by going to metkevin.com/Tesla. No, anyway, this is really interesting. 44,000. That's way cheaper than I thought compared to the X. It's half. You get 90% of the car for half the price. That's crazy. That's really wild. Range is a little low, 260, but frankly, most people don't need this long range stuff. 330, okay, you throw on an extra 5K. Maybe that makes sense for some folks, but I don't think that makes sense for everyone. I think most people, what's the average commute? It's 30 minutes, right? So really, you need less than 100 miles a day for the vast majority of time. Most households today also have multiple vehicles. So, I wouldn't buy a new car just for the odd time you have to commute a distance. I hate driving, by the way. I also refuse to do the latest update, the latest software update. Somebody yesterday told me that was a really good idea because I guess the nags are more annoying now. What's this? What does Dan think? What do you think, Mr. Green Screen Dan here? And why do you have this gloominess behind you?
And those two picks are Amazon, which tends to gain share during a recession. But we also think it's got a lot of profit margin expansion potential going into 2024 based on all the capacity they built during COVID. And the second one we think is Meta. That was actually a top pick of ours for this past year, and it was the second performing name in the S&P 500.
Ooh, somebody here writes, do you think that this could create a bottom for margin for Tesla? Yes, actually. Oh, I hate it when it does this. It actually could create a bottom for margins for Tesla. That's come on, go away. Press any button. I'm pressing buttons, you moron. There we go. Oh no, I shouldn't have used the channel button. That's all right. There we go. But yeah, that's actually a good question. I agree with you. So yeah, but I don't know. Who knows? It's a lot of it's going to come down to labor and production costs for their COGS. I'm not so worried. Well, am I worried about their CapEx? Not really, actually. Not with those delivery numbers. So I'm not worried so much about their cash flow, especially since I think Elon's hit the brakes a little bit in the last quarter on some of the CapEx spend. Scott says his commute's an hour each way. Yeah, an hour each way. Even if your commute was an hour each way, which that sucks, by the way. Sorry. But hey, maybe that means we get to hang out more on video. But, man, I don't know. Can you move closer? 2 hours out of your day, dude. If you have to do that 5 times a week, that's 10 hours of your life. I don't know. I hope you have a Tesla. Anyway, so yeah, even if your commute's an hour, that's 120 plus give it a miscellaneous 30 for other crap you want to. You still have plenty of battery in a 260 vehicle, but you're going to be pretty low at the end of that day. Yeah. All right. So, all right. let's see what else this Neil dude has to say here, and we'll get some other things to look at too.
7 in general is multiple expansion. If you look at Meta, however, I think you've got a couple of things going on. Number one, they're using AI really well to increase the monetization of their ads, and they're also using it to increase recommendation of their videos. But don't forget, we've got an election coming up, and this is probably going to be one of the most hotly contested elections we've ever seen. So a lot of money is going to pour into the online ad market, and so that should help drive ad pricing up, which should help Meta. And then from a outside chance, we've been talking about glasses and mixed reality and all of this stuff for a really long time. And Meta's collaboration with Ray-Ban, where they're introducing something you can wear on your face that you might actually wear, unlike the ski goggles that Apple introduced at $3,000. You've got something that might have a chance, outside chance, when you get to the end of next year, of being the way that people choose to use AI in something that they can just wear. And
yeah, all right. Okay, Max, thank you for sending over TikTok. Oh, I hate these, man. I'll look at it, but I don't know. Like, the vast majority of the time, these are just, and I haven't seen this yet, the greatest cherry-picked data ever, and complete nonsense, but whatever. Let's listen to it for a minute. Let me make sure I can first turn on audio here. I think it's one of these.
Mean reversion thing, it's been down so.
No? Let me see. All right, let's see if we can play this.
Disdain
In all of history. And I think I know why. Let's start by talking to our good buddy, Fred. If you don't know, Fred is the official website from the Federal Reserve where they publish all kinds of official economic data. And Fred can tell you a lot of things. Like, for example, that US GDP, the total value of all the stuff that the US...
I love how they drew the line, the purple line. Like, it continues forever. Yes, the debt has been growing unsustainably. This is true, but I love where we're going with this already.
US makes that's real is going up slowly, and that US debt is skyrocketing. This is not news to anyone that has eyes. I mean, we've all seen the meme of Jerome Powell and his money printer by now. No matter how you slice it.
Well, now we're already mixing things together. Yes, debt has gone up unsustainably, but now we're whatever.
Money's just getting printed. They measure the total money in the system in different ways. They call them M1, M2, M3. M1 is a particularly cute chart. M2 includes more theoretical money that's just numbers in other screens. And so that spike in 2020 is not quite as intense because it has more factors involved. But no matter what you look at, the money supply is going to the moon. But you know what else is going to the moon? Derivatives exposure. Again, GDP is on this chart in green because it's not changing at all, really, while derivatives are skyrocketing. Derivative is the financial term for like placing bets that are just arbitrary that we make up ourselves, not like buying a stock and the stock's value goes up because the company's value goes up. Derivatives are people in the financial institutions or just you and me making bets based upon other things. Like, I bet JP Morgan stock will be worth this much more on that day.
Oh my God.
I'll put $1,000 on it, which sounds legit because it's, people.
Okay, get to the point. Oh man, this is killing me.
Huge amounts of leverage in the system because JP Morgan stock might go up by $1, but we might have bets that mean that.
All right. Get to the everything bubble is about to burst part. Come on, man.
In the real world, we're talking millions and billions of dollars. It's an extremely complex topic, but just so you know what we're talking about here, the top 3 financial institutions in the United States are currently sitting on $50 trillion worth of derivative bets each.
Yeah, okay. Well, that doesn't mean that's how much money they actually bet. All right, let's fast forward a little bit. This is 8 minutes long? I didn't know you could do videos this long. Everything bubble. I'm not watching all this crap. This guy's bothering me.
Pieces of it as investments, like, a company.
Okay, student loans, big deal. Okay, whatever. I'm just going to scroll around here. Let's see. Motor vehicle loans owned. Okay, yes, loans are up. Oh, there's that derivatives chart again. Yes, okay. Who cares? Oh, no. Okay, now we're going to show Gary Gensler and Janet Yellen. Where? Oh, and now we're going to go look at Jerome Powell's background. Okay. Oh, and then Gensler's background. Okay. And now we're going to look at the Department of Justice dropping charges against Sam Bankman-Fried for the election interference because basically they said the judge is going to consider that in his sentencing anyway because they've already presented all the arguments. Okay. The Fed funds rate is high, therefore the stock market needs to come down. Bro, this was completely worthless. I mean, I know I didn't watch every minute of this, but just by watching the first 2 minutes and then scrolling through the rest, I'm like, this is like, there was no coherent argument that I saw. I mean, okay, yeah, we know that debt is going up in the United States, but wait a minute. Like, here, how about this chart? Total public debt as a percentage of GDP. Yes, it exploded in COVID. Congratulations. Like, a 5-year-old knows that debt went up during COVID. But look at it as a percentage of our GDP since then. It's actually been down to stable. So, yes, is the debt unsustainable? Will the dollar collapse at some point in the future? Yes. Is that imminent? No. At some point, will the dollar go away? Yeah, but that could be hundreds of years from now. I'm not going to worry about it. I'm certainly not going to place bets on that. And do I care that you have, derivative exposure? I mean, what compare? Like, who cares? Like, that's what our market is built on. I don't know. I don't see the argument here. I don't like it, Max. Let's go back over here.
Here for us, my dear colleague,
Yes,
an old friend.
Thank you.
What are your thoughts? You know, as the year ended, and we've both been away for a bit, but I can still remember, you were getting a little more cautious, particularly when it came to the mega cap, to the Magnificent Seven. Is that still the case?
Yes, and today, for the first time after letting them run for pretty much forever, trimming. Have to. I mean, bulls make money, bears make money, hogs get slaughtered, across the board trim. I think that anybody who does...
Oh, this is interesting. You know, I'm seeing a lot of bets on China. A lot of fund managers setting up to align for China exposure. You've got about 4 out of 10 fund managers right now looking to increase exposure to China relative to not. Now, there are a lot of people making bets that China is at a bottom. And this is an interesting survey. The survey suggests that European investors are more likely to increase their exposure to China than U.S. investors, about 30% more likely when you compare the two. And so I think that's kind of interesting. This idea of Europeans who are having a slower sort of set of economic output data than the United States are more interested in maybe sympathizing with China in slow output. China will be fascinating, mostly because of how wrong consensus is all the time. Remember, consensus at the end of last year was that we were expecting China to, well, markets, I should say, were expecting China to come out with an insane amount of stimulus and boost the economy, and there was going to be this magnificent recovery in China after the release of these COVID restrictions, the sudden sort of rug pull almost of COVID restrictions. And there was this big boom in January that just fizzled out for the rest of the year, and the stimulus came in way weaker than expected. And so Chinese stocks have basically been straight down. I mean, you're at some of the lowest that we've seen in years in Chinese stocks. And so now the consensus says, oh, things are still going to be bad for China. Well, what's the contrarian bet? Bet on China. And we've seen Kenny G and some other pretty big institutions go for making those bets on China. I don't know. Are you going to bet on China? The tough thing is, like, how? You go broad index? Do you go, Alibaba? There's some individual ADR where, in my opinion, you've got a little bit more idiosyncratic risk. I don't know. Probably better off going for a broad index in China, but I don't know. I don't bet on China. I get my exposure through China through companies that either benefit from deflation in China. Those are going to be your manufacturers. Simple. That could be like even an Apple, right? An Nvidia. Now, you do have chip restrictions. I mean, ASML's down this morning due to, some requests from the Biden administration to restrict ASML exports to other countries, specifically China. So you do have political involvement as well as limitations on what kind of chips AMD and Nvidia and otherwise could actually sell to China. But otherwise, you still have Chinese exposure coming from a lot of American companies. And I think it's easy to forget that. So you could get Chinese exposure through companies that we can study a lot better, in my opinion, without being in China. So anyway, let's listen to what's Jim over here on Doomberg saying.
The evidence of the economy, at least through today.
K-Web, yeah, the tech index over there, that's not a bad one.
And so as yields move higher, I think that's what's going to catch everybody by surprise, just like when yields started moving lower 2 months ago, caught everybody by surprise.
Yields moved lower 2 months ago because Bill Ackman, freaking knucklehead trader. I mean, he pulled it off like a badass, but I still remember when he's like, oh, we're going to blow past 5% on the 10-year. We're going way past 5%. The second we get to 4.99, this guy covers his shorts on bonds. It's like, man, you played it so freaking well. It's because he's driving it. Like, people listen to it and then just copy his moves. And it amplified the market. He really, really moved that bond market, which it did lead to a dip in real estate in October, I will say.
And you will wind up seeing it go in the other direction very quickly if rates start going up, because it did back in September and October when rates are going up. So you're going to get these violent moves in sentiment back and forth because of the uncertainty, because no one can remember seeing these types of moves in the bond market, over the last couple of decades.
Samir, does that resonate with you?
It absolutely does. I mean, look, as a market participant, when you see people tilted to one side,
I see the comments here. Barclays downgraded Apple due to what they're calling lackluster iPhone sales in China. Not a surprise. Again, I'm not betting on the Chinese economy at all, especially the Chinese consumer, beyond the nominal exposure that existing companies I have that I invest in that are not Chinese companies or exposed to China. That's the most Chinese exposure I want. Here's your K-Web internet ETF, they call it. I guess I shouldn't say tech, internet. But this is what it looks like. If you want to see K-Web, it's basically straight down since it peaked in about February of 2021. Well, look at that. It peaked at 96 bucks. Right now it's sitting at $27. If I take $27 back, I mean, we're looking at numbers that we have not seen on K-Web since 2016. You're at 7.5-year lows on K-Web right now. That's insane. 7.5-year lows. Wow. That's worse than Disney. I think it is. Hold on a sec here. Disney, COVID, and then pre-COVID. Nope, it's a little bit worse than Disney. Yeah, because they're about 7 years. They're at about 7 years lows. K-Web's at 7.5-year lows. Oh, rip. Yikes.
Even though it's posted 4 straight quarters of declining revenue, and it faces a lot of...
But then again, sometimes that's the buy time, right? Sometimes that's the buy time. Who knows? I don't know. I'm not in China.
Downgrade, rather, to all of those fears. And Apple shares currently lower by about 2.3%, John.
Kelly, thank you. Let's pick up on one line that came out of Barclays. And Samir, I'd love your thoughts on this. This is what Tim Long had to say. We believe the continued period of weak results coupled with multiple expansion is not sustainable. Samir, here's the difficulty for a lot of people. That line was true for much of the last year, and yet this stock kept advancing and closed last year higher by almost 50%. Samir, when you look at Apple, it's a little bit of an odd one, that the core good, the iPhone, basically went ex-growth and the multiple on the stock kept expanding. Samir, what would you take away from that?
That's it. That's the key, is we ended 2022 with really low multiples, especially on those growth stocks, which left room for multiple expansion. And now as we end 2023, coming into 2024, the multiples have already expanded. So the real question you have to ask yourself is, one, do I expect any more multiple expansion? That's one of those do you feel lucky punk types of questions. I would say no, probably you don't get a lot more multiple expansion. So then two, the question is, do you get a lot of earnings growth? And we would argue you probably don't get a lot of that either. So that's the tricky part for 2024 for investors. Again, not for traders, not for people trying to play kind of momentum, but for investors.
I mean, not wrong here. This idea of do you see more multiple expansion? I think I actually wrote this on ehack.com. Actually, let's look at exactly what I wrote. I love it. It's such a little database of my historical opinions as well as facts. And we separate opinion on fact on there, obviously. But profit, I wrote this yesterday, and I marked it as important too. I said 2024 will be about profit. You know, for example, you get Nike's warning. You've got profit being the core driver here, in my opinion, for 2024. Which the companies that get the inflows would be companies that prove they can make the dollar hollers. That's my take. So, and those will be the companies that actually encourage people to get off the sidelines and invest. So I wanted to just read out. I got Barclays Apple note here, so I just want to read it out here really quick. Apple downgraded to underweight. Time for a breather. Tim Long. I love that his last name is Long, and he's downgrading Apple. It's Faye loves irony, I guess. Tim Long, it should be named Tim Short, lowers his rating on Apple from equal weight to underweight, as he believes the continued period of weak results coupled with multiple expansion is not sustainable. The biggest takeaway from his latest checks is an incrementally worse IP15 data point out of China, sales data points, together with developed markets remaining soft. There is some emerging market strength, but not enough to offset China, basically. While he expects a fairly inline December, he lowered his calendar Q1 estimates. He believes that calendar Q1 should be close to seasonal, while the street is modeling a 10 basis point above seasonal beat. What else is Barclays complaining about here? Well, they're also complaining about U.S. large cap banks. Despite bank stocks outperforming the S&P 500 in the final 9 weeks of the year, 2023 was still one of the worst relative performances ever. Specifically, expects investors to focus on a shift to asset quality. That's within the banks. Okay, fine. What else? Macro themes. Bloody, bloody, bloody. No, that's really it. Okay, they don't really have much else. Boring. Okay. What does the Citibank have for us today? Not much. It's boring. Just a bunch of boring stuff. Yeah, okay. All right, well, I'll let you know if there's something else that's not boring. But anyway, let's let me take a look at surveys here. Okie dokie dokie. So next we have, from a survey's point of view, volume returns with gusto as prices for interesting. Wait, what's this? The holidays, it seems, are well and truly behind us. Volume on stock. Okay, these are regarding European stocks. That's fine. We talked about how the first 5 days could set the course for the entire year's returns. Fine. We talked about Iran. Let's see. Oh, the BYD numbers came out as well. And so BYD sold 526,400 fully electric vehicles in the quarter. They are now officially the #1 deliverer of EVs. They just beat out Tesla, who obviously delivered 484,500, as we covered a little bit ago. That just put BYD ahead of Tesla in terms of fully electric vehicles, not including hybrids. That is full battery electric. Yes, verifying. Okay, good. All right. They also do make a lot cheaper of a vehicle and much less focus on FSD, if anything. Nominal focus on ADAS, driver assistance technology, and very, very little focus. It's sort of your mass production Chinese vehicle. I mean, good for them. Okay, let's see. I want to look at the break-evens, maybe. Let's go 5-year break-even. Let's go see what the Fed pricing is looking like with the bond market selling off a little bit at the start of the day. I want to see. 5-year break-even stable at 2.18. So we're not looking at inflation expectations rising. We got the 5-year forward break-even. That's also at the lowest level it's been in about a year. Roughly the lowest level it's been in about a year at 2.15. So the 5-year out number is lower than the near-term 5 years by about 3 basis points, so it's basically the same. Then we've got the 10-2. Well, we could also just look at that really quick because we see the 10-year is at 3.95. And the 2-year is sitting at 4.34. 4.34 minus 3.95. 39 basis points of inversion. That's kind of where we've been sitting. So kind of stable on both ends there. Okay, what about rate cut expectations? Are we getting any changes as we get 15 minutes before the market opens here? Any changes on rate cut expectations? Right now, markets are pricing in to December 18th. We're looking at 6 rate cuts. That would bring us down to about 3.82. Okay. And if we go to add up the percentage of getting those 6 in by December 18th, 6 rate cuts would put us down at 3.75. The odds of that are 72.2%. Oh, that has been paired a little bit. That was as high as 84% last week. So that did get adjusted down a little bit. Yeah, it did. Interesting. Yeah, a little bit, almost a little bit of an unpricing of about 1 rate cut there. Huh. Interesting. Okay. So now, what else? Let's see here. Let's pull this up. Oh, and as we talked about yesterday, we are going through all the staff emails this morning for those of you joining the Gold course for the perspectives on building wealth as an entrepreneur, LLCs, insurance benefits, tax benefits. We touch on everything, legal benefits, productivity in your life, scheduling, nutrition, whatever. The Gold course is kind of this making you an all-around, well-rounded person, the Gold level course, not to imply selling gold. But we're finalizing replying to emails and then get that price increase set in this morning, but we still have emails. The team gets in around 8 to help me knock them out. Okay, so expect responses between sort of like 8 and 10. Okay, next thing here. Financial Times had some interesting pieces, mostly talking about private equity looking for deployments. I was reading this yesterday. It seems like because there was so little deal making in 2022 and 3, a lot of folks are excited to get some private equity deals going for 2024. This was an interesting one as well. Adani regained half of its losses following the massive Hindenburg short. I was looking into this a little bit yesterday. Just wild. And then this was an interesting piece as well. I'll pull this one up on screen. This was, look at this. Here it is. U.S. office owners face $117 billion wall of debt repayments. And I thought San Francisco was going to be the biggest debt market here for offices. It was actually Manhattan. I mean, I suppose that makes sense. Sort of like the office capital of the world, finance capital of the world. But the sheer magnitude, and you're going at $4 billion here in SF to $10 billion. Manhattan is wild. And they do note that expected losses at this point are on a much smaller scale than in the 2008 housing crisis. But they could still wipe out billions of dollars for investors, potentially wipe out some property developers. Actually, I think that's where some deals are to be had, is picking up deals from developers who potentially have debt payments coming due.
100,000 barrels.
Yeah.
Over the course of the year, right?
CNBC talking about the Red Sea trade. Kind of already touched on that. Iranian oil tankers. We're at the very beginning of trying to weather the office market downturn. This is not driven by fundamentals. This has everything to do with financing costs going back up. Well, I disagree with that. I do think there are 110% fundamental reasons why offices are less desirable at the moment. So much work from home, or not work from home. I don't know. I guess it depends. Even as investors wait for the Fed to start cutting rates again, refinancings are getting done eventually. You know, what I think is probably reasonable is some kind of like, I don't know that it's horrible, like as bad to do work from home part of a week, right? Like I'm not like so anti working from home some days a week, but it's so hard to work with a team remotely. I hate like the Zoom and all that kind of stuff. Ugh. It's like, come talk to me in person. Despite the lower rates on these loans, losses could be significant. In December, a group of U.S. economists found that 40% of office loans on bank balance sheets were underwater. Wow, look at that, 40% underwater, potentially causing problems for dozens of regional banks holding them. Well, that's probably why we've started seeing the Fed's bailout facility go up. St. Louis Front, go to Bank Term Funding Program. Yeah, so you go to the Bank Term Funding Program, you could see, oh yeah, it popped up again. Yep. I think this is pure office stress right here. Look at this. Yeah, you're you know, well, hockey sticking or whatever you want to call it here, on bailouts, basically. This is a taxpayer-backed Federal Reserve facility. Any losses here are backed by the taxpayer, but it's basically the Federal Reserve's money printer. And their need to print money at this window to help banks has increased from $113 billion, 113.8, to 135.8 in the span of 1 month. So we have about a 20% increase in use of this bank term funding program in the span of 4 weeks. And regional banks are the oopsie doopsies here. That's your next phase of the potential crisis. Now, keep in mind the bank term funding program doesn't guarantee all your debt. It basically says we'll give you 100% value on your treasury holdings, but you're still taking losses on those office holdings. So that'll be quite interesting to see what happens with some of the smaller banks holding some of these office loans. Where does the bank term funding program money come from? It comes from the money printer. But again, it's guaranteed by the taxpayer. So basically, the Federal Reserve just digitally imagines the money. Now, technically, they say they're not really increasing their sort of debts, so to speak, because they're custodying treasuries that they're assuming are worth 100% that they hold to duration. So there's some fancy accounting there. Right? It's kind of like saying, hey, don't worry that your 10-year treasury bond is worth half of what it was. Let's say it's a $100,000 set of treasury bonds. You give us those $100,000, even though they're only worth $50K, we'll assume they're worth $100K. Here's $100K of money. That's roughly what's happening, and that's money that they just sort of printed up. But yeah, this is the rate of this increase is getting worse as we move forward. Bob here says it's a Ponzi scheme. I mean, it is. But it's not one that I think is going to implode for, our lifetime. So, understand the game and learn how to play it. Yeah, we can fight it all day long, but I don't think that pays off.
Goes and raises the price tag for pretty much all the banks, and I think it makes a lot of sense that interest income is going to trough. What you want to do, well, let's use one that is very interesting. Morgan Stanley, which Mike Trapples also owns. Well, here we go. New CEO, Ted Pick. I think that's interesting. Now, Mike Mayo over Wells Fargo goes even a step further in saying that
Ted Pick? Wait, so the new CEO of Morgan Stanley is Ted Pick. So we got Pick in the last name. We got the guy at Barclay whose last name is Long. And now Jim Cramer's talking about somebody whose last name is Mayo. What is going on today?
it already is a good move.
With not the cutting rates, excuse me, but the expectation rates to stop going up.
Yeah, so, I mean, is this the right time? Yes, it's the right time.
The bank term funding program is a 1-year program. Yeah, that is true. It is temporary. It's 1 year. So your first sort of let's look up the actual thing. Fed Bank Term Funding Program, because there's a whole press release on it from the Fed. But anyway, yeah, terms and conditions. Okay, I have them here. I'm pretty sure it's 1 year. This is like literally a little Word doc they slapped together. Pretty sure I was skiing when I covered this. To provide liquidity to U.S. depositories, the Fed Bank would make advances to eligible borrowers, taking eligible collateral. Okay. Eligible collateral includes Any collateral eligible for purchase by the Fed. Okay. In open market operations. Okay. Provided the collateral was owned by the borrower as of March 12th, so not bought after the banking crisis. That's fair. Advances will be limited to the value of eligible collateral pledged. Okay, that's fine. The rate and term of the advance will be 1 year for at a rate of the overnight swap plus 10 basis points. And the rate will be fixed on the day of the advance. I wonder if maybe that's why we're seeing an increase, because people are trying to fix that for a year as rates are a little lower. Borrowers may repay without penalty. Advances will be made available for up to 1 year. That's the second time they've said that, so they're pretty... Oh, the program's coming to an end. Advances can be requested until March 11th, 2024. So these are the last, like, 3 months that you're going to be eligible to make advances or pull money out of the Bank Term Funding Program. But some of the people who first drew money, right? Like when we lap that, right here, when we start lapping these numbers, those numbers have to start getting repaid. Otherwise, those banks potentially go into default. Although all the Fed has to do is say, like, hey, we'll let you repay that over 10 years, right? And then you don't actually really have a problem. Like, they could just snap their fingers and solve that problem pretty quickly. What they could also do is expand how long you're able to pull money out of this program. You know, like they said, right now advances under the program can be requested until March 11th, but they could totally extend that as well. Yeah. So, all right. Let's see what else here. What else? 3 minutes to the opening bell. Let's take a look at what stocks are making the biggest moves in the pre-market. Okay. Oh, there's Zim. There goes Zim, 5%. Marathon, 13%. Tesla, 75 basis points. Not a lot of green here. Not a lot of green. Oh, I was just on a Jupiter run yesterday. I mean, this company's a total scam. But anyway, in my opinion, Jupiter is a great run at the Park City Mountain Resort. Rivian down about 6.4 after slightly missing on those deliveries. Apple down 2.5. Affirm's coming off its highness. Makes you wonder if, does it make sense to go short as like a short-term trade? Does it make sense to go short a firm where it's sitting now? Because I think this is now the second day in a row you're red. Makes you wonder if, maybe redraw the retracements, not from all the way back here, but redraw the retracements more appropriately with what we have here recently. Let's see what's going on. See if it's run too much. 90 seconds to the opening bell. We'll go to our course member live stream about 15 minutes after that. As usual, we'll do some analysis. We love doing the fundies. Fed will set pace more than ever this year. What's this talk? We'll get ready for the bell here. The surge in consumer prices that drove inflation way past the central bank's targets in recent years led to a wave of interest rate hikes. Okay, let's start the article out redundant. But as policymakers were desperate to rebuild credibility, their zeal threatened to savage growth and spark unemployment. Fine, don't fight the Fed. Truism should become the obligatory screensaver of every trader and portfolio manager. Okay, after 11 hikes, the market now sees the tide turning. Fed easing, fine. Fed reduction is likely to be substantial 50. When it comes, the first Fed reduction is likely to be 50 basis points. Really? They actually think the first cut is going to be 50 rather than a series of 25s. Oh, Doomberg. Interesting. Let's get the bell.
Gensler does a lot of jawboning.
Didn't work.
A lot of jawboning.
He wants people to be in ones. Look, I mean, when you speak to him, he just would like everybody involved to have to be like it's a registered security. And he failed. And I think even the Commodity Futures Trading Committee mission is not aligned with that.
All right.
Very positive.
Here comes the opening bell.
Yeah, that's like 85% red, maybe 90% red there. It does look like Tesla's trying to hold on to it. It's about 75 basis points of green. See how that ends up moving here. It's bobbing around there. It's not looking too healthy right now. Oh, yep, I was trying to push red. You've got Enphase trying to push red here. You've got Nvidia pushing red. Looks like the weight of red is coming. The wave of red. It's a red wave. Is this what they meant when they said red wave? Yeah, you've got Apple down still 2.5 here. There's Rivian. Some of these initial opening trades here. Looks like you got some red coming in. Oh, Nasdaq's trying a green candle. Trying to. It's still down quite a bit. SoFi down about 3%. Oh, wait. I just saw SoFi there and then it disappeared. Where'd it go? What is SoFi? Maybe it's not actually down. Yeah, no, it's down 3.3%. Tesla's about to lose the lead here. You only got about 20 basis points of green to go. Lots of red right now. First 15 minutes of trade are always pretty interesting, though. Look at the S&P 500. Try to sneak a little bit of green in there. Yeah, same thing with the Nasdaq. So we'll see how, once we get past some of these opening trades, how things end up moving. Peloton's down 4%. Sort these by gains and losses here. Got Rivian down 8.4, SoFi 3.2, Affirm's about 4% down, Palantir down another 2.8, Enphase down 2 at 129. Looking at the upside, Zim's not moving that much. Tesla barely holding on to 25 basis points here. All right, let's listen in.
Together with developing markets remaining soft. Now, they do go on to have what?
Oh, they're still on about Apple. Okay, fine. So I'm surprised about this idea about a 50 basis point cut. That's very interesting. And they're really talking about growth trends and quote-unquote landing the economic plane. But a 50 BP cut to start with, that almost would make it seem like something's wrong. The prospective easing cycle is likely to be both quicker and shorter than the last 2 years. Futures markets badly underestimated the central bank's resolve to curb consumer prices. Oh, they're basically making this argument that now that you have inflation actually behaving quite well, assuming it stays, keeps its behavior this way. Oh, there it goes.
Lost the lead.
Test to turn red. Assuming that inflation via the multivariate core that we were looking at earlier continues to stay this low, is there the possible argument that the rate cut cycle could be a lot shorter than the 2 years it took to raise rates? That's interesting. It's an interesting argument. I don't know. We'll see. Look at that. Little by the dippy doodle opportunity, I suppose. Almost down 1% now on Tesla there. Okay, good. So let's take a look at, I want to see also oil and bonds. How are they moving right now? Okay, so bonds right now still have 8.4 basis points on the 10-year. Oil sitting just under 78 on WTI Brent. That's up almost 1%. And Tesla now down a full 1%. Apple hasn't moved down much more. If anything, Apple's trying to recover from about the 2.5% down. Rivian's down almost 10%. Nvidia down about 2%. Intel's down 2% as well. Amazon's negative. Yeah, Marathon's the only. Marathon and Zim, shipping company. Well, basically, your only greens over here. Okay. Let's see what they have over on the Doombergs. As well as, Oh, interesting. There we go. Okay, here, let's see here. Top Wall Street bull says stocks to pause. U.S. stocks are likely to take a breather from their rapid gains before a potential fresh catalyst arrives in the form of the next earnings season, says Oppenheimer Asset Management. Yeah, I wouldn't be surprised if you're getting some desire to basically sit out some of the market push until we get earnings. Earnings are a big deal. Two-ish weeks away from earnings really starting. Earnings season is always so entertaining. Yeah, let's look at Netflix is usually always first, right? So let's look at the calendar for Netflix. And they set the standard. Those stinkers. Netflix is set for, January 23rd, a little later than I was expecting. But we might get the banks before that, right? Let me see here. Let's try like JPM. So if I go JPM, when are they going to report? The 12th. There you go. So we are 10 days away from JPM. And I think some of the airlines report pretty early too. But it's usually the banks and the Netflix. Yeah, Delta reports on the 12th as well. Wells Fargo Corporation, they report on the 12th. So does anybody really report before the 12th? That would be the question. Just for catalyst sakes, I don't think the answer to that is yes. But let's find out. So, calendar, we have Monday the 8th. No. I mean, Jeffries, Tilray on the, what is that, the 11th here, I think that's, no, that's the 9th. After, on the 9th, you have WD-40. No. KB Homes on the 10th. Yeah, and then here you go. On the Friday the 12th, JP Morgan, Delta, Bank of America, Wells Fargo, BlackRock. That's your start of earnings season as the 12th. Morgan Stanley, Goldman Sachs on the 16th. Citi, 17th. Then you're going to get into another weekend. Then you get to the 22nd. You got United, Verizon on the 23rd, Johnson & Johnson, Procter & Gamble. There it is, Netflix. That'll start your tech move on the 23rd. AT&T, ASML, GE, Tesla on the 24th. Yep. American Express that week. Oh, yeah. Then it gets juicy. Then we start getting into UPS and otherwise. Okay. All right. So looking at this, what am I looking at here? This is NVIDIA. NVIDIA is trying to fall off a cliff. 2.5% here. When does NVIDIA report? I don't know. These are all catalyst dates to write down. Tesla's still down about 0.5%. NVIDIA reports on the 20th of February. So you've got about a month-long window there of earnings season that can make things a little poopy-doopy. Yeah. I'll be updating eHack throughout the day today as well. So pay attention to eHack. Just check that every so often. My goal is to, I know the last, although I think I've put some pretty good quality stuff up over here during the holidays. Definitely been posting less, both videos and eHack than I've been desiring to during the holidays. But then again, you got to spend time with family too. I had a bitch-ass time with family. Bitchin'-ass time, that'd be the way to put it. A good time. There, that's the more PC way. So it was really fun. Hopefully you all had a great time with family, friends, whatever, as well. And Happy New Year, of course. Okay, so I'm trying to see other stories here. Man, there's like a drought of stuff here. We got the Oppenheimer target. That's fine. Imagine this. Tom Lee is forecasting stocks to do well this year. I mean, that's like saying, hey, breaking news, the Pope is Catholic. Nah, there's nothing there. Boring. No, that's boring. Will 2024 mark the end of the post-pandemic economy? All right, let's take a look at what this argument is here. Allison has an argument. Let's see here. The post-pandemic economy was marked by several unlikely factors: shortages, inflation, expansion of monetary and fiscal debts. All that stimulus increased household savings. The result was an increase in rates, an economy that stayed somewhat resilient. Now in 2024, it's increasingly clear that America has spent its post-pandemic dividend. I don't know if that's true yet. Households in the bottom half of the economic distribution don't have much excess savings. Yeah, that's true. The upper half still has. They're the ones buying all those Teslas. Is eHack for members? No, eHack's totally free. Totally, it's always going to be free. Literally, just go to eHack.com. And you can scroll through and look at the history. I think it's a fantastic tool. Yeah. Yeah, there you go. eHack.com, exactly. So somebody says change the screen. they don't like this, the plummeting NVIDIA chart. Okay. Let me find a green chart for you. Oh, look! Restoration hardware went positive. Oh, but that's still not a pretty chart. Here we go. There we go. There, Zim. Okay? That's the one I was talking about as a trade this morning. Like, does it make sense to go long this? Short term. These it's so sensitive. And then a firm, I said go short. This morning, long Zim, short a firm. And a firm dropped another 2.5% since then. Pay attention. I don't know how long those will hold. I'm still short Costco. Like what? I pick a boring stock to go short. Somebody's like, "Hey man, only selecting green is racist." Oh my god. Okay, let's see here. What else? These days are coming to the end. Blah blah blah. There is a chance, like my fellow economist, that I'm wrong. Perhaps the Fed will be able to reduce rates without much damage to the economy. We'll have immaculate disinflation. Oh, so they believe basically that the Fed's going to have to cut because everybody's out of money and the economy's going to falter. Yeah, I mean, like I said, there's a reason I'm focusing my investments on the richer half of America. Random says, Kevin, why not live on YouTube? I'm surprised that it doesn't show up that I am live on YouTube, but we're on the Meet Kevin. What I did is I have a new channel, the Meet Kevin Stock Market Open. We just do all the lives for the Stock Market Open, or if I do close, it'll be on this one. So I've separated those just because I was noticing the Market Open lives were competing with videos that I was posting during the day. So so then I stopped doing Market Open lives, but then that upset people because we enjoy the Market Open lives. So I just put them in different places. Anyway, there goes Zim. And there goes the firm. It's continuing. But so is Tesla. Red candles matter too. Oh, stop. All right. Anyway, so I think it's time for this button.
Go yourself.
I mean this one.
Is that clear?
Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial
3%.
advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker. All right, 10-year Treasury is holding on to its 9 basis point increase. Stocks selling off as a result of that, likely. And of course, going into earnings season, how could you rally going into earnings season? You can't. Everybody's nervous. Everybody's like taking their money off the table, going, "What are earnings gonna do?" Totally normal, totally expected, folks. Go into the course member live stream after I fill up this cup of coffee again.